Remember, you can't work tirelessly forever, nor should you want to. You deserve the freedom to live life on your own terms, and this requires having your money work for you through assets. It's important to understand that assets differ significantly from merely depositing your money in a savings account. While a savings account offers minimal growth on your hard-earned income, assets, they have the potential to substantially increase your wealth. The key here is compounding, a process where the earnings from an asset are reinvested to generate additional earnings over time. This compounding effect allows your wealth to grow exponentially, as both the initial investment and the earnings from that investment earn further returns. In this video, we'll talk about that in detail. The more you invest in assets, the quicker your wealth grows, accelerating your journey to financial prosperity. When you want to use the power of compounding effects, you do not need a lot of money. While real estate might be costly, accessible assets like dividend-paying stocks can be purchased for as little as $5 daily, weekly, or monthly, depending on your comfort level. Did you know that Warren Buffett, one of the world's most successful investors, generates a staggering 71% of his dividend income from just 5 stocks? Imagine starting with just $5 and growing it into a fortune, allowing you to retire early and live off your investments. How does Buffett do it? And more importantly, how can you replicate his success? Join us as we learn how to invest in dividends like Warren Buffett does. 57.7% of Warren Buffett's $375 billion portfolio is invested in 2 dividend-paying stocks, Apple and Bank of America.
The answer is I do believe in dividends in a great many situations, including many of the ones companies in which we own stock. The test about whether to pay dividends is whether you can continue to create more than $1 of value for every dollar you retain.
A practical strategy for leveraging compounding is the 5-to-1 rule. For every $5 spent on liabilities, allocate $1 to assets. For instance, if you spend $15 at Walmart, invest $3 back into Walmart stocks. Similarly, an $80 expenditure at Costco means investing $16 in Costco shares. This approach ensures a balanced and strategic investment aligned with your spending habits, allowing you to benefit from the compounding effect over time. To truly grasp the essence of dividend investing, it's essential to understand that dividends are more than just regular payouts from companies to their shareholders. They represent a company's commitment to sharing its success with those who invested in its journey. When a company earns a profit, it has a few options: reinvest in the business, save it for future use, or distribute it to the shareholders. Dividends are this third option, a real profit on your investment, and they can be a significant source of income, especially in a well-diversified portfolio. But dividends offer more than just income. They're a sign of a company's health and stability. Firms that consistently pay dividends are often well-established and financially sound. They're the kind of companies that have weathered economic storms and emerged strong. Now let's turn our attention to Warren Buffett, a name synonymous with wise investing. Buffett's approach to dividend investing is deeply rooted in his overall investment philosophy. Focus on value, not just price. He seeks out companies that are not only profitable, but also have a durable competitive advantage. This could be a strong brand, a unique product, or a dominant market position. Anything that sets the company apart and protects it from competitors. Buffett's portfolio, featuring names like Coca-Cola and Apple, is proof of this strategy. These are companies that are not just leaders in their respective industries, they are institutions that have stood the test of time. Coca-Cola, for instance, they've been paying dividends since 1920, and its product, a simple soft drink, has remained largely unchanged for over a century, yet it continues to be in demand globally. Apple, on the other hand, is a relatively younger company, but has revolutionized the technology sector multiple times, creating this brand loyalty that's hard to match. What's remarkable about Buffett's dividend strategy is his focus on the long-term potential of these dividends.
Recommending that people buy stocks today or tomorrow or next week or next month. I think it all depends on your circumstances, but you shouldn't buy stocks unless you expect, in my view, you expect to hold them for a very extended period, and you are prepared financially and psychologically.
He is not looking for high yields in the short term. Instead, he's more interested in the growth potential of these dividends over time. It's about the incremental increase in payouts, the compounding effect that can turn modest initial yields into substantial income streams over decades. As we've seen from Warren Buffett's approach, dividend investing is not just about immediate returns. It's about the long-term growth and the stability of your investments. But there is another crucial element to this strategy, one that Buffett often refers to as the eighth wonder of the world. And as I said at the beginning of the video, that we would talk about this in more depth.
Blue chip stamps when we owned it, or even diversified retained. We wanted them all to be compounding, in effect, be compounding machines. That's why people gave us capital. That's why we put our own capital in.
This concept becomes particularly powerful when applied to dividend investing. When you receive dividends, you have a choice. Take the cash or reinvest it to buy more shares. Buffett advocates for the latter. By reinvesting dividends, you're essentially using your earnings to increase your investment, which in turn will generate more dividends in the future. It's a cycle of growth that, over time, can lead to exponential increases in the value of your investment. Think of it this way. If you invest in a stock that pays dividends and those dividends are reinvested, you're not just earning on your initial investment. You're earning on every subsequent investment made from those dividends from that initial stake. Over time, this can lead to a significantly larger portfolio than if you had just simply taken the dividends as cash. After exploring the theoretical aspects of compounding in dividend investing, as highlighted by Warren Buffett, let's look at some real-life examples that demonstrate how small, consistent investments in dividend stocks can grow over time. Grace Groner's story is a classic example of how patience and a long-term view can lead to extraordinary results in dividend investing. In 1935, Grace, a secretary with a modest income, bought 3 shares of Abbott Laboratories stock for about $180. She held on to these shares for her entire life, consistently reinvesting the dividends. Over the years, thanks to stock splits and the power of compounding, her initial investment grew to an incredible $7 million by the time of her death in 2010. Grace's investment journey is a powerful illustration of the impact of reinvesting dividends and the growth potential of a well-chosen stock over several decades. Another compelling example is that of Ann Schriber, a retired IRS auditor who turned a $5,000 investment in the 1940s into a $22 million fortune by the time of her death in 1995. Ann achieved this remarkable feat by investing in dividend-paying stocks and consistently reinvesting those dividends. Her portfolio included companies like PepsiCo and Bristol-Myers Squibb, which grew quietly but powerfully over the decades. The story of Ann shows how a relatively small investment can grow into a large fortune over time, showing how powerful compounding can really be. Now let's imagine a hypothetical individual who starts investing $100 a month in a diversified portfolio of dividend-paying stocks at the age of 25. She reinvests all her dividends and has continued this practice for 40 years. Assuming an average annual return of 7%, including dividend reinvestment, by the time she is 65, her portfolio would now be worth over $250,000. This hypothetical scenario highlights how even a modest, regular investment can accumulate into a significant sum over a long period of time, thanks to the power of compounding. These examples make the main point clear. When you invest in dividends, it's not about how much you start with, but how consistently you do it and whether you decide to reinvest your dividends. The power of compounding in dividend investing is a proven strategy for wealth accumulation over time, and is accessible to anyone who adopts a patient and disciplined investment approach. After exploring the power of compounding in real-life success stories, you might be wondering, how can I start my own journey in dividend investing? The good news is, you don't need a fortune to begin with. In fact, you can start with as little as $5. In today's digital age, investing has become more accessible than ever before. Platforms like Robinhood and Acorns have revolutionized the investment landscape, allowing individuals to start investing with small amounts. These platforms are user-friendly, making them ideal for beginners. With Robinhood, you can buy fractional shares of stocks, meaning that you can invest in high-value stocks with a modest amount. Acorns, on the other hand, specializes in micro-investing, rounding up your daily purchases to the nearest dollar and investing the spare change. This approach makes investing almost effortless and is a fantastic way to start building your portfolio, even with limited funds. The importance of starting early cannot be overstated. You can use the power of compounding more if you start investing early, even if you are only putting in small amounts. Time is an investor's greatest asset, and starting early gives your investments more time to grow and compound. Selecting the right dividend-paying stocks is crucial. You want to look for companies with a history of stable and growing dividends. These are typically well-established firms with a strong track record of profitability and financial health. When choosing stocks, consider factors like dividend yield, payout ratio, and the company's overall financial stability. For research, there are numerous resources available. Kiplinger's list of the best Warren Buffett dividend stocks is a great place to start. This list provides insights into the types of companies that Buffett invests in, which are known for their strong dividends and growth potential. Additionally, financial news websites, stock market analysis platforms, and investment forums can offer valuable information to help you make informed decisions. Remember, the goal is to build a diversified portfolio of dividend-paying stocks that aligns with your investment goals and risk tolerance. It's not about picking the next big winner, but about choosing solid companies that can provide steady income and long-term growth. As we venture into the final part of our journey through dividend investing, it's crucial to address the risks and considerations involved. Understanding these aspects is key to navigating the stock market successfully. First and foremost, it's important to acknowledge that investing in the stock market involves risks, including market volatility. Stock prices fluctuate daily due to various factors, like economic changes, political events, and market sentiment. These fluctuations can be particularly pronounced in the short term, leading to potential losses. However, it's essential to maintain a long-term perspective. Warren Buffett himself is known for his long-term investment approach, often saying our favorite holding period is forever. This mindset is particularly important in dividend investing. While short-term market movements can be unsettling, a long-term view allows investors to ride out the ups and downs and benefit from the gradual growth and compounding of dividends. Remember, the stock market has historically trended upwards over the long term, despite short-term volatility. By focusing on the long-term potential of your investments and not reacting impulsively to short-term market movements, you can align your strategy more closely with the proven approach of successful investors like Buffett. Another critical aspect of a sound investment strategy is diversification. Diversification involves spreading out your investments across various sectors, industries, and geographies to reduce your risk. The idea is to not put all of your eggs into one basket, but to have a mix of investments that could potentially offset losses in one area with gains in another. Warren Buffett's portfolio is a prime example of diversification. While he invests heavily in certain sectors like financials and consumer goods, his holdings span a range of industries, from technology to healthcare. This diversification helps mitigate the risks associated with any single sector or company. In the context of dividend investing, diversification means having a portfolio of dividend-paying stocks from different industries and possibly different countries. This approach can provide a buffer against sector-specific downturns and market volatility. It's also worth considering other asset classes like bonds or real estate investment trusts as a part of a diversified portfolio. Adopting a long-term perspective and ensuring diversification in your investment portfolio are key strategies to lower these risks. By understanding and managing these aspects, you can position yourself for a more secure and potentially rewarding investment journey. Warren Buffett's success in dividend investing is not just about picking the right stocks. It's about patience, reinvestment, and smart strategies. Starting with as little as $5, you can start on a journey toward financial independence, following in the footsteps of one of the greatest investors of our time. Remember, it's not about timing the market, but time in the market that counts. Start small, think big, and watch your investments grow.